The big four banks are predicting interest rate hikes, and for savers, that means locking in term deposits could carry risks.
Markets now expect interest rate hikes to replace cuts in 2026.
The sentiment has definitely changed in the market. They're baking in another 2 potential interest rates. Do you think the two-speed economy will take a bigger hit on this?
That's what scares me. A lot of the sentiment around interest rates is already taking place in the markets. It's becoming the perfect storm. Interest rates all of a sudden surprise everyone and get to 7%. I've got a cash burn. I've got a cash flow problem. Debt's getting out of control in this country. It's going to get harder to get debt from the majors. So that stat, you're seeing a 25% uplift in second tier and private debt. You're going to see that stat probably increase even more. We've seen a push to unique circumstances.
Increasing by the day. There was an article released recently that they're estimating $3 billion worth of mortgage fraud across the majors. You're listening to the Follio Property Podcast. I'm Reece and I'm here each week with my co-host Lachlan Delahunty. Particularly in the finance space, I thought, look, we were keen to do a quick one today just because there's a lot going on just to address. Hey guys, quick thing to share. If you're serious about investing in Australian property right now, you need to see what we put together. It's called the National Investment Report, and it's our brand new monthly deep dive into exactly where the market is moving, what the data is saying, and what the smart investors are looking at right now. You can get the first access completely free. Just scan the QR code on the screen right now or click in the link below to fill out the form. Let's kick started with interest rates. Now, we've spoken about on the podcast over the last few weeks, even months to a certain extent, that the sentiment has definitely changed in the market. They're baking in another 2 potential interest rates. Do you think the two-speed economy will take a bigger hit on this?
Definitely. I think the divide between the markets that are cooling and those that are continuing to rise, that gap's only going to get more exaggerated as these rate rises start to come in.
And from a property investment perspective, you're hearing a lot of people, ourselves included, out there saying this is some of the best buying conditions in certain areas. Do you think that's still being the case if we do see another 2 rate rises, or is that going to really impact the property market?
The sentiment's already factored in those rate rises. So while we're seeing now, arguably some of the best buying conditions we've seen since COVID, the market is completely uncertain at the moment. So what does that mean? Historically, you'll see going into a federal election or the May budget, there's little activity, and that's what we're seeing at the moment. But overlay that with uncertain macroeconomic matters, be the war in Iran taking place, that's another element of uncertainty. And on the back of that, likely rising inflation and therefore rising interest rates. So those 3 things essentially just equals complete uncertainty in the market. Sentiment, as we know, Reece, drives market, be that with speculation and or doom and gloom as we're seeing it take place at the moment. So I think a lot of the sentiment around interest rates is already taking place in the markets. I don't foresee the events, be that the rate rises, being any more catastrophic than what the sentiment's already doing. Does that make sense?
Yeah. Do experienced investors care about interest rates, or are they purely focused on market conditions?
Definitely, especially if you've got a lot of debt rates or a larger portfolio. If you see 50 bips in the next 3 months, that has a tangible impact on your cash flow. So I think playing the long term in terms of capital growth and where the markets sit, a sophisticated investor will look past that and will only see this moment in time as an opportunity. While everyone else is fearful, I'm going to capitalise. But what you will keep an eye on, what I'm personally keeping an eye on, is how can I get this asset to wash its face? Previously, I was doing my numbers on a 6% interest rate. I might conservatively now do that on a 7% interest rate, which sounds extreme. But when I'm looking at yields and how I can manufacture increased cash flow, I want to keep one eye on that, because if I go out there and buy all these assets on 2.5-3% yields and then interest rates all of a sudden surprise everyone and get to 7%, I've got a cash burn. I've got a cash flow problem. So absolutely, as a sophisticated investor, I've got to be doing my numbers on what does this mean.
Mortgage fraud is increasing by the day. There was an article released recently that they're estimating $3 billion worth of mortgage fraud across the majors. So that's your NABs, your CBAs, ANZs, Macquaries. Now, one of the big things that came out in the article that recently got released is it is AI driven, where documents are getting falsification of documents, whether that being a pay slip, bank statement, employment details. How much of a concern do you see that from a regulatory perspective?
Yeah, when you think fraud, you think these serious offences, right? You think people are money laundering, those sorts of things. But it's not. It's your everyday, misdemeanors. You could almost say that's where your boss might increase your pay slip, or you've falsified your spending habits, those sorts of things, or you get an accountant to sign off on your ability to service that trust. That's fraud, right? So they're the cases that when I read that article, looking into it, I'm like, what's going on? Is there a lot of international fraud, a lot of money coming into Australia that shouldn't be? It's not that. It's your everyday mum and dad investors that are misreporting or falsifying some documentation to get more debt. So what does it mean? It just means banks' ability to assess individuals is going to become better than ever. They're getting access to information. So the ability to get credit's only going to get harder as AI improves. And so you're going to see credit starting to tighten. We're seeing that across the board. And I think in the next 12 to 18 months, getting debt is going to become increasingly harder from the major and your first-tier lenders. You're going to see a rise in private funders and second-tier lenders as the major four start to clamp down on giving out access to credit, as we discussed with AI and fraud and those sorts of things. Your private lenders, your second-tier institutes will start to mop up and open up the floodgates. It's
going to be interesting to see from the fraudulent activity whether that does see a spike in adverse credit or bad credit. NAB recently came out with an article saying that they've increased their bad debt forecast this year from 706 million to 300 million. Off the back of the Iran war and global conditions. Westpac and CBA have had similar articles recently as well, but it does feel like there could be some correlation between the mortgage fraud as well.
Yeah, and we've got stagnant markets, in the likes of Sydney and pockets of, Queensland, New South Wales and Victoria, right? So what happens when the markets are rising? These default stories aren't as common because, price growth and equity sort of is overshadowing any sort of default payments or anything like that, right? But now we've got stagnant markets and markets are coming backwards. Those that have, fraudulently falsified documentation to get debt when they probably shouldn't or had the ability to get that debt, so their income wasn't high enough, etc., of course it's going to increase in defaults. And when you don't have markets, record growth year-on-year market growth to support your portfolio, you're going to see more defaults and it's a little bit concerning, Reece. I'm not going to lie.
It definitely is concerning just because of the Iran war's only been going, 6-8 weeks at this stage. So for NAB to come out and more than double their increase in bad debt this year shows they're probably already seeing a tick up in arrears on their current book, particularly in certain cohorts as well. So obviously we mentioned there in terms of the fraudulent activity, whether that has anything to do with it or if it's maybe more some of these lower socio-demographic areas that are feeling the crunch.
It is concerning because, like I said, it's only been going for 8 weeks. The cracks are out there. They're starting to surface. I get concerns for those major markets that are going backwards.
So NAB, CBA, Westpac, all mentioning sort of a bad credit spike. We've talked through the fraudulent activity of $3 billion across the majors as well. The next part of this whole story is non-bank lending. And we've spoken about this on podcasts before. For those that haven't heard this before, non-bank lenders are those that don't have access to retail funds, generally borrow from a big four like we're talking to fund that money. They don't have the regulatory obligations like some of the big four do as well. And generally they're a bit looser on their credit policy, quicker turnaround time. So the big stat that came out sort of over the last 12 months is we've seen a 25.3% jump in non-bank lending. And that, just a comparison from majors, that's only a 3.9%. So you're seeing the majors say there's some bad debt coming here, there's some fraudulent activity.
So who would have thought the second, third and fourth tier lenders say, open up the banks, I'll give you some money. This private debt, Reece, this private second tier, third tier lending stuff, private debt, Reeks of 2007. But to say there's been, a 24% increase in 25% increase in second tier lending. This is really concerning, Reece. That's what starts to worry me when you've got stagnant markets, uncertainty, rising interest rates, majors clamping down on fraud, trust lending, investor activity through the roof. Yet we've got our non-regulatory banks, we've got our non-regulatory lenders, second, third, fourth tier and private lenders, just giving out money. Reeks at 2007. Are you a property investor? If so, we have just launched our property portfolio solution, which is helping our clients maximize their portfolio, not by adding more properties, but getting more bang for buck in terms of output across their entire portfolio. It's adding the 1, 2, 3%ers to get those marginal differences to get more output over the long term. If you're interested, click the link below or scan the QR code to join our waiting list.
I think the thing for myself as well has been heavily invested in this industry for nearly 10 years. The stat that scares me is there's 10% of Australian consumer credit is by non-bank lenders. Now, most non-bank lenders, the reason they're there is a stopgap, whether that is personal circumstances, gets you into the market, then it's to then go to
business owners that struggle to have pay slips and those sort of things. Yeah,
maybe people who went through a divorce.
It's for the minority, right? Absolute. Should be sort of
1
2
in
to
10.
2 to 3%, and we're talking 10%.
Let's go down on the investor credit growth as well. So we've spoken about this before, but we've seen 40% of new 40% of new loans are investor-led, highest since 2017.
And what happened in 2017, Reece? Take a walk back in time. That's when the banks pretty much, APRA stepped in and they almost pretty well terminated interest-only loans for investment properties. That was 2017. We're talking big milestones, and that absolutely cooled the markets across the country. So it's nerve-wracking to see that stat, because I'm sure APRA are looking at that activity and saying, how can we put the handbrake on that?
The biggest stat here that I know you're super excited to talk about.
Not excited. I'm scared to talk about it.
Scared to talk about it. Investor lending in December grew by 1%, which is the highest since June 2007.
That's what scares me. Really scares me. And everyone knows what 2007 was. 12 months pretty much to the day of the GFC. It was in August 2008. So investor debt, the highest it's ever been since the GFC. Private debt, second, third, fourth tier lenders increasing their borrowing by 25% in an environment where we're seeing rates go up. Makes me a little nervous.
We saw APRA, and we've touched on this on previous podcasts, where they had a cap at 6 times debt to income, which we spoke about. It was a bit of a fugazi. It wasn't impacting too many investors. They also clamped down on trust lending to really try to stamp out the speculators. Looking at some of the policies here, though, from the majors that stepped away, it does still appear that they are lending in trust lending, I should say, provided there is some sort of, in most cases, some sort of relationship there. Maybe they've got lending already and the bank knows the client. So showing some intent that they are getting rid of the speculator. Do you see any more clampdown? We've mentioned here some figures that happened, or some policy changes that happened in 2017. Is that what's next in 2026? Are we going to see the removal of interest-only lending?
I think we'll see what happens in the May budget first, right? Looking at capital gains and negative gearing as 2 levers to potentially reduce some of the investment activity. That may be enough from APRA's point of view to cool it. But I'm sure seeing that uplift in December, but naturally increasing interest rates is going to remove some investment sentiment. So, but it's something to watch. What I think will be making people more nervous is the amount of private or unregulated debt that's now going through our country. In a stagnant economy across the board, obviously we invest in markets and the sub-markets within markets, but you're seeing our biggest powerhouse, be that New South Wales and Sydney, come off the boil quite aggressively, and prestige Melbourne really start to cool. The large portion of the market's coming off in a rising interest rate environment. It starts to create some concern, Reece.
It's interesting there. We mentioned the concerns. We mentioned the rising interest rate environments. The last thing I wanted to touch on was LVRs. We're seeing, whether that be the government coming out with schemes or lenders themselves increasing their LVRs or increasing their no LMI on LVRs. How much of concern do you think that is heading into 2026 off the back of potential stagnant markets, depending on where you're buying, and also the raising rates?
Yeah, it's becoming the perfect storm. Balanced market, post-GFC, LVR went from 70%, times improved, it went to 80%. 80%'s been common practice for most of 2010s. 80% LVR is common practice. We've seen a push to unique circumstances, medical professions, accountants, those where job security is very high, to push the threshold to 90%, 95%. And now we've had a government pretty much give that same benefit that you normally see with medical professions to first home buyers. And now banks across the board stepping in and saying we'll give 85, 90% with no LMI. Shackles are off, Reece. So I can see why there's going to be some lenders that are going to have to put the handbrakes on, because debt's getting out of control in this country.
Just to summarise all that, there's a lot of topical points that we've spoken in terms of debt, whether we're talking fraud, whether we're talking non-bank lending, the way we're structuring this. If you cast a crystal ball into 2027, you mentioned there earlier that you see it tightening from a credit perspective. What does the landscape look like back into 2026, 2027 in terms of the lending space?
It's going to get harder to get debt from the majors. It's going to be easy to get it from your second, third, fourth tiers and your private debt. So I think that stat, you're seeing a 25% uplift in second tier and private debt, you're going to see that stat probably increase even more, which concerns me.
You've been listening to the Follio Property Podcast.